Have you ever looked at the stock market and felt overwhelmed, like it was a storm, full of noise, charts, headlines, and numbers flying around like confetti? Now imagine this. You're standing on the edge of that storm, holding nothing but your curiosity and a smartphone. No finance degree, no insider info, just a quiet desire to grow your savings and build something for the future. That was Alice. 6 years ago, she wasn't a financial expert. She wasn't even confident speaking the language of money, but what she did have was courage. And she had ChatGPT, not just for translations or quick answers, but as a companion, a flashlight in the fog of investing. This is not just a story about picking stocks. It's a story about clarity, patience, and the emotional roller coaster of learning how to invest. It's about how one person used simple tools step by step to not only survive, but grow through a global pandemic, inflation shocks, and market meltdowns. And maybe it's your story too. Maybe you're standing where Alice once stood, at the very beginning. So, let's walk through the 6 lessons that helped Alice stay in the game. The mindset, the analysis, the small wins, and the sleepless nights. Everything that turns a beginner into an investor with quiet confidence. Let's begin. Part 1. See the big picture. Understanding macroeconomics. Alice's first wake-up call came in 2020. The pandemic had just struck, and markets around the world crashed overnight. She saw the news, headlines screaming about job losses, factory shutdowns, travel bans. Everyone around her was panicking, but something told her to pause, to ask, why is this happening? ChatGPT explained the basics. When an economy shuts down, people stop spending. Companies stop earning. Governments panic. Central banks slash interest rates to encourage borrowing. That, in turn, makes stocks more attractive because savings accounts earn nothing. She began reading about fiscal policy, stimulus packages, and interest rates. It all sounded so complex at first, but slowly she saw the pattern. When the US printed trillions of dollars to stimulate the economy, that money had to go somewhere. And a lot of it went into stocks. Then she noticed something interesting. While most businesses were suffering, some sectors were actually thriving. E-commerce, healthcare, tech. Zoom became a household name. Amazon's stock soared. Moderna, a relatively unknown biotech company, was suddenly in the spotlight. She connected the dots: macro trends, sector impact, company growth. Instead of guessing, she began filtering stocks through this lens. What was the world facing? Who could benefit? Who would struggle? One key example. In early 2021, inflation fears started rising. Everyone expected the Federal Reserve to raise interest rates soon. That would hurt high-growth tech stocks, but it could boost banks. So Alice bought a regional bank stock. Boring? Yes, but it had solid fundamentals. And when the Fed eventually raised rates, bank margins expanded, and so did the stock price. She didn't just react. She understood. And for the first time, Alice felt calm when the market trembled. It wasn't magic. It was macro. Part 2. The power of cash flow, more than just numbers. When Alice first started learning about investing, she often got lost in the sea of numbers. EPS, revenue growth, debt ratios, it felt overwhelming. But after some time, she stumbled upon one concept that truly changed how she looked at stocks: cash flow. It wasn't just about profit anymore. It was about the real, tangible money a business actually had on hand. Imagine this: 2 friends, Mike and Sarah, both run small coffee shops. Mike's business shows a great profit on paper, $50,000 a year. But here's the catch. All that profit is tied up in equipment, inventory and delayed customer payments. His bank account? Almost empty. He struggles to pay rent each month. On the other hand, Sarah only shows a $35,000 profit on paper, but she collects payments fast, spends wisely, and has low overhead. She has $20,000 sitting in the bank, ready to reinvest, expand, or save for tough times. Now ask yourself, whose business is healthier? This is the exact question Alice began to ask when she looked at a company's cash flow statement. She realized that many companies reported profits, but their operating cash flow, the money coming in from their actual business, was weak. Others might even show a loss on paper, but had strong, consistent cash flows because of smart reinvestments and accounting write-offs. She started using this insight when analyzing stocks. One of her early picks was a well-known consumer staples company. Let's call it Clean Care Incorporated. During the pandemic, most investors chased high-growth tech stocks. Clean Care wasn't exciting. Its growth was slow. But when Alice dug deeper, she saw that despite market chaos, Clean Care had incredibly strong free cash flow year after year. They sold essentials, soap, disinfectant, household cleaners, things people needed no matter what the economy was doing. While tech stocks dropped 40% in a market correction, Clean Care's stock stayed stable and even rose over time. Why? Because investors realized the same thing Alice did. Reliable cash flow is king, especially during uncertain times. Cash flow also helped Alice avoid traps. At one point, she almost bought shares in a fast fashion brand exploding on social media. Revenue was skyrocketing. But when she checked the cash flow statement, she found that the company was burning through cash every quarter and borrowing heavily to stay afloat. That was a red flag, and she walked away. Over time, Alice learned a simple rule. If the money doesn't flow, the business won't grow. She stopped getting seduced by big revenue numbers or flashy marketing. She started asking better questions. Does this company generate more cash than it spends? Are they consistently free cash flow positive? How do they reinvest that cash? These became her compass. And the best part? These questions worked whether she was analyzing a large healthcare company or a small local brand. In fact, looking at cash flow also gave her peace of mind. She wasn't just investing in stories anymore. She was investing in businesses that had the strength to survive storms. So if you're listening to this and just starting your journey, remember, numbers matter, but not all numbers are equal. Focus on the lifeblood of a business. Don't just fall for earnings per share. Ask, is there real cash? Is the business sustainable? Cash flow isn't sexy. It's not the headline that gets everyone excited, but it's what keeps the lights on. It's what keeps employees paid. And it's what helped Alice build a portfolio she could trust. Her confidence grew, not because she predicted the market, but because she finally understood what made a company truly resilient. And that brings us to the next key element in Alice's journey, valuation. Because even if a company is great, how do you know if it's worth buying right now? Let's find out. Part 3. The Price of Belief, Alice and the Lesson of Valuation. Alice started to understand the stock market, not only with her brain, but with her mistakes. In the spring of her second year investing, she bought shares of a tech company called Skybright. Everyone was talking about it, in news articles, on stock forums, even in her friends' chats. People said it was the future of digital change. The company's sales had grown 200% in 2 years. The stock chart was always going up. Trust felt easier than thinking. She didn't look at the P/E ratio. She didn't check PAB. She never asked herself, Am I buying profits or am I buying a dream? Skybright's PE was over 90. That means for every $1 the company earned, people were paying $90 for the stock. But all Alice heard was the cheering crowd. So she bought in. 3 months later, the stock dropped 40%. Not because the company was bad, but because the market changed. People were worried about rising interest rates. Money was harder to get. Suddenly, companies that lost money weren't popular anymore. Alice felt lost. She asked herself why the market was so unfair. But in that moment, she sat down quietly, opened the company's financial report, and typed, "What is PE?" into ChatGPT. Numbers that speak. She learned something simple. P/E shows how much people are willing to pay for $1 of profit. Skybright wasn't a bad company. But with a PE of 90, people expected it to grow fast, nonstop, like a rocket. But in real life, nobody can run forever without getting tired, she thought. She looked at another company, Harvest Bank, a small local bank. Some called it slow, old-fashioned. Its PE was only 8. It made profit every year. It paid dividends. No one talked about it in the news. But it kept working, kept earning money, even during COVID. It was not exciting, but it was real. Alice started to see. A high PE means high expectations. If expectations are too high, even good news may feel like not enough. A low PE means people don't expect much, so even small improvements can cause big changes. PB, when the market doesn't see the value. She then studied POB, price to book. It shows how much people pay compared to a company's real assets. One rainy day in late August, she found a company called North River Logistics. It owned hundreds of old trucks and warehouses. It had been around since the 1980s. No one on social media talked about it. Its PB was 0.6. That means if the company closed and sold everything it owned, shareholders would get more money than the stock was worth. Why does the market ignore real things? She wondered. She did more research. North River had lost a big client, and gas prices were rising. But it had little debt and still made a profit. She remembered Skybright, a billion-dollar company with almost no physical assets. And now she found North River, a real business with real things that no one cared about. She bought a few shares, not to get rich fast, but to try something new, being quiet and patient. Valuation is about psychology, not just math. Alice no longer saw PE or PB as formulas. They were mirrors. A high PE shows excitement. A low one might show fear. A low PB might mean people lost faith, or that they haven't noticed value yet. She learned to pause before buying. She asked, "Is this company creating real value, or just telling a good story? Is the market too excited, or has it forgotten something good? Am I buying because I understand, or because I don't want to miss out?" A lesson she'll never forget. In early 2023, she watched a company called Solara, working in green energy. The PE was 65 because everyone loved clean tech. She liked the industry, but the price felt too high. She waited. 6 months later, the market fell. Solara's PE dropped to 28. The company still made profits. Government support stayed strong. But investors were scared. She bought in. 1 year later, the stock was up 60%. But more than that, she was proud, not because she guessed right, but because she understood. True value isn't just numbers. In the end, Alice learned one big truth. No number can fully explain a company's value without context. PE and PB are just tools like a thermometer. They measure market feelings. But a good investor must know when the market has a cold and when it's just dreaming too much. Alice decided to move slowly now. She didn't need hot picks to show off. She wanted stocks she could stay with. She no longer feared cheap stocks. She knew true value will speak for itself, but only to those who wait and listen. Part 4. The right time, learning to read the market's language. By her 3rd year, Alice knew more than she ever thought she would. She understood macro trends. She read company reports. She checked POE and PB. But there was still one question that made her nervous. When should I buy? Sometimes she found a great company, solid business, good numbers, nice dividend. But after she bought, the stock still went down. Other times she waited too long. The price jumped, and she missed the chance. She realized, knowing what to buy is not enough. You must also learn when to buy. And that's when she started learning about technical analysis. A chart is a story without words. One evening, Alice watched a video called The Basics of Technical Analysis. She saw lines, shapes, candles, green and red. At first, it all looked confusing, but slowly she began to see this was just another kind of story. A stock chart shows the emotions of the market: fear, greed, hope, panic. And like people, stocks have patterns. She learned simple ideas. Support, the price where a stock often stops falling. Resistance, the price where it often stops rising. Trend, the direction, up, down, or sideways. A volume, how many people are trading. More volume means more strength. It started to make sense. Her first lesson, the false breakout. She tested her new skills on a company called Everplant, a green farming business. She liked the fundamentals. The company was growing slowly but steadily. PE was 12. It looked safe. She watched the chart. The price had hit $30 3 times in the last 6 months, but never passed it. That was the resistance. One morning, the price hit 31. It looked like a breakout. Excited, Alice bought in. But the next day, the stock fell to 28. Then 26. She felt stupid. But she didn't sell. She looked at the volume. It had been low. She realized, a true breakout needs power. No volume, no strength. She waited 3 more weeks. The price went up again, this time to 32 with strong volume. She bought again. This time it held. It climbed to 38 in 2 months. She learned. The chart tells you what people believe, not just what a company is worth. Her second lesson, buy when others are tired. Alice used to chase hot stocks. But now she looked for resting ones. She followed a company called Safeport Energy. It wasn't in the news. Its stock had gone sideways for 5 months. But the company made steady profits. It had little debt, and oil prices were rising globally. She drew a trend line. The price had touched a low point 3 times, around $45. That was the support. She waited. One morning, the price touched 45 again, then bounced up fast. She bought. Over the next 10 weeks, it climbed slowly but strongly to 55. No one was talking about it, but Alice smiled. The best time to buy is when nobody's watching, she thought. Emotions leave footprints. Technical analysis taught her one big truth. The market moves in waves. People get excited, then tired, then scared, then hopeful again. Every chart shows that rhythm. She also learned about RSI, the Relative Strength Index. When it's over 70, a stock might be too hot. Under 30, maybe oversold. She didn't use it as a rule, only a sign, like checking the weather before a walk. The chart can't see the future, she reminded herself, but it helps me understand the present. The real power, patience. There was one week Alice wanted to buy a tech stock. It was rising fast, but the RSI was 82. She remembered, it's overbought. She waited. 3 days later, the price dropped 12%. Then it slowly rose again calmly. She bought on the second wave, not because of fear or FOMO, but because the chart felt steady. She didn't win every time. Sometimes she was too early, sometimes too late. But now she had a guide, not just guessing but listening. She no longer saw charts as noise. She saw them as music, repeating, flowing, with rhythm and silence. A new kind of confidence. Alice started combining what she knew. Macro trends told her what industries to watch. Company reports told her which businesses were strong. Evaluation told her if the price was fair. And charts told her when the moment felt right. She wasn't just buying stocks now. She was building a plan. She wasn't rushing. She was reading the economy, the company, the market, her own emotions. The stock market is not a place to be loud, she whispered in one podcast episode she recorded for new investors. It's a place to observe, to understand, to act when it's time. Part 5. Holding on, riding the storms of the market. By her 4th year in the stock market, Alice had more experience. She had wins, she had losses. But most of all, she had stories. And in those stories, there was always one thing that tested her the most. Fear. Not the quiet fear of making mistakes, but the loud, fast, heavy fear that comes during a market crash. And Alice would never forget the crash of 2020. The world changed overnight. It started like any other week. Stocks were high. People were happy. Businesses were strong. Then the virus came. COVID-19. Within days, cities closed. Flights stopped. Stores emptied. The world felt scared, and the market felt it too. In just 2 weeks, Alice saw her portfolio drop by 30%. Her best stocks, the safe ones, were red. Even the defensive companies. Even utilities. What should I do? She asked herself again and again. Her hands were cold. Her heart was racing. She wanted to sell everything and run. But something inside her said, breathe. Go back to the basics. She opened her journal. Alice had always kept a simple notebook beside her desk. Inside were her rules. Only buy what you understand. Think long term. Don't panic in red. Always keep some cash. Buy more when great stocks are on sale. That last line gave her pause. She took a sip of tea and whispered, maybe this is not the end. Maybe this is a discount. She turned to ChatGPT, asking, what happened during the last crisis? It told her about 2008, about 2001, even about the Great Depression. Every time the market had fallen. Every time it had also recovered, sometimes slowly but always. She smiled. History became her friend. Choosing courage. That week, Alice did something bold. She took the rest of her savings and picked 3 stocks she believed in deeply. A clean energy company, a global health firm, and a tech platform that helps schools teach online. All of them were 40% cheaper than 1 month before. She clicked buy. Her hands still shook, but her heart felt steady. This is not fear, she told herself. This is a decision. The next month was hard. The market moved like waves, up, down, sideways. But she stopped checking her portfolio every day. Instead, she focused on learning, reading, resting. Time passed slowly, then fast. By the end of the year, the market had begun to rise. Vaccine news came. Stores opened. People smiled again. Alice's portfolio rose with the recovery. Her 3 new stocks doubled in 18 months. Her old positions returned to green. But it wasn't the money that made her proud. It was the fact that she didn't run. She had stood still while the storm passed. She learned the most important rule in investing. Your emotions are louder than the market, but they don't have to control you. A lesson from nature. One morning, Alice went for a walk in the forest. It was quiet. Wind blew gently through the trees. She looked at a tall pine tree and thought, "That's how I want to be. Rooted. Still, even when the storm comes." Investing, she realized, is not about speed. It's about staying. Anyone can buy. Many people sell. But only a few hold with calm, with faith, with a long view. She wasn't trying to become rich fast anymore. She wanted to become strong, like that tree. Speaking to the newcomers. On her podcast, she shared this. "If you're just starting, I won't tell you to be brave. That takes time. But I'll tell you this, don't panic because of one bad day, or one bad month, or even one bad year. The market is not always fair today, but over time it becomes fair." She reminded her listeners, keep some cash, buy slowly, trust your process, and above all, breathe. Her new habit. From that year forward, Alice created a habit. Every time the market went red, she paused. She wrote in her journal. She asked, "What's really happening? Is the business still good? Is this price a gift?" If the answers were calm, she would stay calm. She became a long-term investor. Not in words, but in actions. A quiet kind of power. By her 6th year, Alice wasn't scared of market drops anymore. She didn't try to guess the top or the bottom. She learned to ride the waves, slowly, wisely, patiently. "The market is like the ocean," she said in one episode. "You can't control it, but you can learn to swim." And that's what she did. Part 6. Clarity. Building a life, not just a portfolio. It had been 6 years since Alice bought her first stock. 6 years of learning, winning, losing, doubting, growing. The market had gone up. It had crashed. It had surprised her many times. But now, as she sat in her small home office, with a warm coffee in hand and a calm mind in her heart, she smiled. "I used to look for fast profits," she said in her latest podcast episode. "Now I look for slow freedom." The numbers meant more. Alice opened her portfolio. She saw a list of stocks, some red, some green, some steady. But she didn't just see numbers anymore. She saw stories. Her healthcare stock reminded her of the COVID storm and how she stayed strong. Her clean energy stock reminded her of the time she trusted her research, even when no one else cared. Her boring utility stock reminded her of peace. Slow, stable, almost quiet peace. "I didn't just build a portfolio," she whispered. "I built trust in myself." From noise to focus. In the past, Alice read every market headline, every tweet, every forecast. Now she checked the news once a week. She focused on what mattered. Big changes in the world. Real shifts in business. Moments when prices didn't match value. She didn't chase the market anymore. She waited. She didn't need to predict. She just needed to prepare. Her thoughts became sharper. Her emotions became softer. She had learned. Less noise, more focus. Money with meaning. At first, investing was about making more. Now it was about creating space. She had enough to breathe. Enough to help her parents. Enough to rest. She didn't want millions. She wanted enough. Enough to live slow, she said. To read in the morning. To walk after lunch. To choose peace. And that, to her, was the greatest profit. Teaching others. Alice started helping friends. She didn't promise quick wins. She didn't show off her returns. Instead, she asked, "Why do you want to invest? What do you believe in? What can you wait for?" She taught them the basics, macro, company health, PE support lines. But more than that, she taught patience. One friend said, But it's so boring. She laughed. That's good. Boring is safe. Boring is strong. Boring means your money is working even when you're not. A life in balance. Alice didn't spend all her time thinking about stocks anymore. She made time to garden, to cook, to volunteer, to travel a little. She let her portfolio grow like a tree, slowly, silently, deeply. Some weeks it was red, some months it was flat. But she wasn't chasing numbers. She was living. Investing is not your life, she told her podcast listeners. It's the soil. You are the seed. You choose how to grow. Looking back and forward. One evening, Alice opened her first trading account, the one she started 6 years ago. She saw that very first stock she bought. A small dividend company. Still there. Still paying. She felt proud, not because of how much money she made, but because she stayed. She stayed through panic, through greed, through silence, through waiting. And now, she understood what long-term really means. Not just holding a stock, but holding a vision. Her final words. In her last episode of the season, Alice spoke quietly. This journey isn't about being perfect. It's about being present. You don't have to guess right every time. You just have to keep learning, keep listening, keep going. She paused. And remember, your best investment is not a stock. It's your mind, your heart, your calm. Learn to grow those and the rest will follow. So here we are, my friend, the end of this story, but not the end of your journey. In fact, this might just be the beginning. Over 6 chapters, we followed Alice, a beginner who knew nothing about the market, but everything about trying. She didn't come from a finance background. She wasn't born into wealth. But what she had was the courage to learn, to ask questions, to get it wrong and get up again. She learned to read the signs of the world, the big economic waves that move the market. She learned to study businesses, their cash flow, their heartbeats. She explored numbers, the humble PE and PB ratios that hide powerful truths. She practiced charts and support levels, not to gamble, but to wait for the right time. She faced fear, doubt, greed, hope, and she found her rhythm, her balance, her own voice in a noisy world. Because investing at its core is not just about money. It's about mastering your emotions. It's learning to breathe when things fall, to pause before chasing. It's the art of thinking clearly when everyone else is panicking loudly. It's not about being first. It's about being calm, being curious, being consistent. And the truth is, we're all a bit like Alice. We all start somewhere. We all get overwhelmed. But step by step, lesson by lesson, mistake by mistake, we grow. Not just richer in money, but richer in wisdom, in patience, in peace. If this story spoke to you, I invite you to keep walking this path with us. Subscribe to Richness Journey, your space to learn, grow, and build wealth not just in your bank account, but in your mind and heart. Because in the end, your best investment will always be in yourself. Until next time, stay steady, stay curious, and stay rich in what matters most.